Give me 1 second. Okay. All right. Okay. Tarek, I'm going to unmute your mic. Thanks for joining us, and take good notes and ask your questions, folks. There's lots to learn here.
Sam, just before we started, are you able to give me the present or give me permission to present so I can share my screen? And B, I'm unable to see what everybody's typing.
Oh, I see. Okay, give me 1 second. Second. You see now? Can you see now, Tarek? Tarek, you're going to have to reestablish your connection for volume
There
and
you go.
sound.
Can you hear me now, Sam? Let's see here.
Yeah, I can. Can you see the text box?
No, all I see is my desktop, and
Okay, so when you go to desktop and you share Tarek, you'll see that there's a box or a thin line where
right here.
see that black box right there in the bottom
Yeah.
right hand corner? Yeah. That box, if you click
Okay,
on
there you
one of
go.
them, you'll see where you can see people
Perfect.
what the
Yeah,
questions are asking. You see it now?
you're welcome. So just to introduce myself, everyone, my name is Tarek Soufan. I work with Sam on some of his deals, and he's asked me to share some of my expertise with you tonight. Can everybody hear me? Okay, just type in a Y there on your keypads there. Just let me know. Perfect. Okay, so we'll dive right in here. So I've created just a quick just a quick image for you guys to kind of view with me, just to kind of give us some guidance for tonight's session. These are the areas that we're going to be discussing tonight. So we're going to talk about mortgage lenders. We're going to talk about the insurers. The big one here is the 5 C's of lending. I think we'll spend most of our time in that section. Credit reporting agencies, I'm sure most of you are familiar with those. And then we'll talk about some mortgage underwriting and the different mortgage programs that are available. If anybody has any questions while I'm going along here, just feel free to type in the text box there. Or if I'm talking too fast or not loud enough, by all means, just send me a quick message and we'll adjust. Okay. So first, well, I guess for the sake of time, let's start off with section 3 here, the 5 C's of lending. So we'll talk about capital, collateral, capacity, GDSR, TDSR, which are your debt service ratios, character, and credit worthiness. And the reason why I want to talk about this group of topics is because these are the main areas that all lenders are looking at. So whether this be a loan for a car, a mortgage, a line of credit, these are the areas that the lender are going to be scrutinizing. So capital refers to your assets. So what are your assets in this case? Collateral is usually the home or the car that's being purchased. Capacity is your ability to service your debt. So you could have all the assets in the world, but if you don't have a capacity to service your debt, so if you don't have income coming in monthly, um, it doesn't matter if you have $1 million sitting in your bank account. If you're unable to service your debt, they're not going to give you a mortgage. GDSR, TDSR, those are your debt service ratios, and we'll talk about those in a second. Character is basically what it sounds like. It's your character. So, are you a 21-year-old, just got a job, making $40,000 a year, and you're coming in to apply for a mortgage? Or are you somebody who's established, who's been in the same career for the last 10 years, et cetera, et cetera? Credit worthiness is what it sounds like. It's your credit score. So they'll pull your credit bureau, they'll take a look at that, and based on what your score is, they'll decide whether or not you're able to get a mortgage. So everything in this section determines whether or not you'll be approved for a mortgage, for a loan, or a line of credit. So if there's anything I want you to take away from tonight's meeting is focus on these areas here, because those are the most important to you as future borrowers of capital in your pursuit of purchasing real estate. You're going to need to be familiar with these. So rather than wasting the time of the lender, if you can do a quick calculation at your end and check your credit using the different credit reporting agencies like Credit Karma and Borrowell, if you're able to do this stuff at your end, you'll know whether or not you'll be approved even before you get to sit with the lender. But you also have to be aware of the different programs that are available. So it's not just this area here. We'll talk about the different programs that are available, and you'll always want to speak to a professional, whether it be a mortgage broker. And I actually recommend that you see a mortgage broker before you see your banker, just because they have greater access to different lenders and whatnot, and they have different programs as well. Okay, so let's talk about the debt service ratios, because those are the biggest things that determine those in credit and capacity are the three biggest areas that a lender looks at. So I'm going to pull up. Sam, can you do me a favor? Can you pull up the whiteboard for a minute? We're just going to do some quick math here.
Tarek, you have to pull it up on your end, my friend.
Okay.
So you can share, go to a new share.
Okay.
If you go to new share and you drop the drop down box, it'll let you bring up a whiteboard.
Okay.
Or if you go over to the box, it says go to the right. If you go to the complete, almost to the end of the right, there's a drop down. And it says hide, max, request control. Do you see that?
What are you looking at here?
You see your box there?
Yeah.
Hold on one sec, Tarek. Let me see if I can share your screen. No, it won't let me do that. Okay, so at the top, if you go to meeting, let's see if it's in meeting. Can you access it from meeting or layout? Pods? You see any of that?
No. I see preferences. Chat pod. Whiteboard.
Whiteboard, you have it?
Yeah.
Okay. You see under layouts? Do you have layouts?
Oh, wait a second. Can you see what I'm doing here?
Yeah, you're writing right now.
Okay, so let me do that. All right, so let's pull up a new file here. How do I take this out now? There, can you see that, Sam?
That's perfect.
Okay.
Prepare your fresh white screen. Yep.
Okay. So we're gonna pull up. We'll start with GDSR. What that stands for is gross debt service ratio. So does anybody know what that means exactly, or what the number is that the lender is looking for? Okay, I'm going to throw up the number. This is the maximum that you're allowed to spend on your debt from the perspective of the lender. So 39% of your income can be allocated for the following. So let's go through a scenario here. Okay, so here we go. My screen. Okay, so this is a sample mortgage calculator. So if you want to figure out what your mortgage payment is, you can use a calculator like this, for example. So let's say, for example, you wanted to purchase a property, and let's say you needed to borrow $500,000. And the reason why I've got 5.34 here, so the going rate today is 2.99%. So anybody can walk into a bank and get a 5-year mortgage at 2.99%, which is fine and dandy. But for the sake of the calculation, the lender is not going to actually use the rate that they're giving you. They're going to use what we call the posted rate. And the 5-year posted rate right now is 5.34%. Sorry?
Art?
Yep.
My apologies. Is there any way you can make that bigger?
The
amplify the website.
Oh, is it small?
It is small. Yeah, it's hard to see. I believe if you can enlarge that. It's the website. You can increase the size of it. You're using which browser?
I'm using Internet Explorer. Oh, sorry. Yeah, Internet Explorer.
Internet Explorer.
You know what I can do? Hold on.
Okay, if you go to
I got a better idea.
go to settings.
Let me just do this here.
Well, you can do that too. Yeah.
Is that better?
That's better. Much better.
Okay.
That's excellent. Now you can see the numbers. Excellent. Okay. Thank you.
Okay. So if we use the posted rate, which is what the lender is going to be using, the actual payment is $3,006 a month. So just to give you an idea of what your actual payment would be. So although your actual payment at a 2.99% mortgage would be $2,364, the payment that they use for the purpose of the calculation is $3,006. There's about a $630 difference there. And the reason why they do that is because in case interest rates go up in the future, they want to be sure that you're able to handle your debt. So they're going to use this number as the number to service the loan. Okay, so I'm going to switch back here because I can't really see it on my screen. So we're just looking for the number here. So the number that we need to remember is 3006. All right. Sorry, Sam, I'm trying to get back to that whiteboard now. So I think what we have to do is we have to somehow stop this share.
There you go. Click down the share my screen drop down. There you go. Excellent.
Oh, yeah, what happened to our little thing that we're working on there?
That now is behind that.
Okay. Okay, I'll try to. Okay, I'll do it real quick here. But you know what I should do? I should do it in Excel, in Word. Is this big enough for you to see? Can you see that well or no?
You got to hit enter.
Okay,
no, we don't see anything. Better to work in Word, yeah. Share your screen and just work on Word.
All right.
There you go. Perfect. Okay. There we go. Now we can see your screen. So yeah, Word's better. You just want it in here too. If you look at your bottom left corner in your Word document, you can zoom that.
Is this big enough, Herb? Is the text big enough for you to see?
Can you zoom just a little bit, Tark? If you look in the
Sorry?
bottom right-hand corner of Word,
Yep.
you see there's a zoom bar. See the zoom bar? Just zoom it a little bit.
Is that better?
Much better. Yeah, that's much better.
Okay. You'll see different rates posted. So you'll see some lenders do 32%. You'll see some at 34%. But the maximum allowable is 39. So we're going to work with 39. So the mortgage payment in this case was $3,005. Yeah, $3,006. Property tax on a property like this would be about $600 a month. Heat's at 100. There's no condo fees. So if this person's income, gross income, is $100,000 a year, what we're saying is the maximum that he's able to spend, or the maximum that they're able to spend on these three items is 39% of 100,000. So in this case, that's $39,000 a year. That's the most they can spend. Well, if you do the math, that's $36,000 on mortgage. That's $7,200 on property tax. So you're at $42,000 at this point, plus your heat. So you're at $43,000. So that's $43,000 a year. So in this case, if we're saying the maximum he can spend is $39,000, and the expenses are $43,000 a year, this deal's not going to go through. So he's unable. The client in this case would be unable to borrow the $500,000 that they're looking for to get this mortgage. His income can't change. I mean, he makes $100,000 a year, so we can't adjust that. What we can do is we can adjust the down payment to bring the total amount borrowed down below $500,000.
Tark, what about additional? So this is an individual. Is this? What if it was household income? If it was two people that were purchasing, that were both on the purchase, that would be combined income.
Yeah, you could even put 3 or 4 people on the deal. I've seen, I've seen brother, sister, and mother, father go on a deal before, and they took all 4 incomes. So after that, they're going to start to raise their eyebrows. But yeah, you can have multiple people on the property, and they'll factor that in. So it's at this point, for this ratio, that would fly. So you put a second person on there. So let's say their income now is $150,000 a year. All right, so the maximum they can spend. Do you have a calculator there, Sam?
Just another 18,000. It's another. Sorry, it's another 19,500. 19,500.
All right. All right. So in this case, there's no issues there. The max they can spend is over $50,000. The debts that look into the service are $43,000. So in this case, the deal would fly. All right. That's the first ratio that the lender is going to look at. It's not the only ratio, but that's one of the main ratios. The other ratio that they're going to look at, and this is where having a second, and third, and fourth person may come at your detriment, is the total debt service ratio.
Sorry to interrupt. Just in reference to gross debt service ratio. Now, if I have 3 people that are on that loan, are all of them going to need to qualify equally? Or is one a primary? Does that work? Or is it just one individual? Each individual on that has to qualify. In other words, their credit has to be sound. There's no issues there. Is it just one is getting qualified, the additional income is added to them?
So they qualify everybody, but for this case, the fixed costs stay the same. Mortgage payment doesn't change. Property tax and E, that doesn't change. By adding a second person, you're increasing the income, so you're lowering that ratio, which is good. Right now, the
But
person still has to have decent credit. But if you've got a deal where it's a husband and wife, and one has excellent credit, and one has bruised credit, that's fine.
yeah.
If you have two people with
Oh, I
bruised
see.
credit, it's going to be harder.
Okay, but it can be done with one person with good credit and 2 or 3 additional people put on, correct?
Absolutely.
So
Okay.
Lee's got a question. He's saying gross income. Can you just define that?
Here, let me put that in there. Sure. So your gross income is your taxable income. So we don't care what the net is. They look at it. Everything that they look at is based on gross income. So you could be a business owner and maybe your gross income is $180,000 a year, but after all your deductions and whatnot, let's say you're taking home 110. That's irrelevant. They're looking at the gross income.
The bigger number, Lee. So they're looking at the bigger number. They just, I want to reiterate, they want to qualify you. They want to find a way to qualify you because they don't make any money unless they give a loan. But there are restrictions that are put upon them, and there are things that they do to protect themselves. So they're going to do what they can to get you qualified. That's why you want to work with a broker that's creative and understands this stuff extensively, so they don't just look at you and say, well, on the surface you don't qualify, period, you can't qualify. You want someone who can go deeper and say, look, in this situation, what we're going to have to do is add a second person, or in this situation, we're going to need a co-signer, or in this situation, these are our 1, 2, 3 options. That's the kind of creativity that you want.
Okay. So if we have two people, husband and wife, in the first section, the first debt service ratio, the gross debt service ratio, having that extra person helps because you increase their income. Where it becomes a little bit dicey is in the TDSR because now they're looking at the other person's debts. So now we've gone past your mortgage payment, your property tax, your heat. We take all that and then we throw in all the other debts. So student loans, for example, any sort of revolving credit. So student loans, lines of credit, loans, card payments, credit card payments, and they're not looking at the minimum payments. So, every debt has a different way of being factored in. So with credit cards, for example, they're going to take 3% of the balance monthly. So if you're somebody who pays the minimum and you're thinking, okay, I pay $100 a month on my credit card, I'm going to factor in $100 for the total debt service ratio. It doesn't work that way. They're going to take 3% of the balance. So if you've got a $10,000 credit card and your spouse has a $10,000 credit card, you're looking at pretty much $600 a month to service this. Let's say they have no loan, and for the loan, it's the same thing. They're looking at 3% of the balance monthly. Lines of credit, if it's a secured line of credit, they'll take a minimum payment on that. So they'll do up to 1% a month. Sorry, they'll do a minimum of 1% a month. And then student loans, whatever the loan amount is that you pay monthly is the amount they're going to factor in. And the car loans are the same. So if your car loan is $300 a month, they're going to factor $300 a month into the car loan for the car loan. So in this case, we're adding an additional. Sorry, go ahead, Sam.
I was going to say, what about when the situation, if you explain a little bit, walking into the bank and having $100,000 available in credit, but none of it used? The motivation by the bank to say you need to close those down. Where does that come from?
Well, the banks realize that at some point you have access to this $100,000 line of credit or credit facility, and that you could potentially use it. And if you do potentially use it, how does that change the service ratios? So they're going to ask you to close it or bring it to a point so that the debt is manageable and the debt can be serviced at the levels that we're indicating here. Right?
Okay.
So sometimes even if you have, and I've seen this happen, it depends on the lender, but sometimes if you have too many credit cards, even if you have a zero balance, they may factor in having them all maxed and what that looks like and where that puts them in line in terms of your ability to pay. and they may ask you to lower the limits on some of those credit cards. They may ask you to close them. They may ask you to transfer them over to that lender as well. It just depends. That's something that used to happen a lot more in the past. Since they brought up the new mortgage rules, lenders want to lend and they know that it's harder. They're not doing that as much.
I see.
Right.
Okay.
Now, in terms of the amounts, so your total debt service ratio can be as high as 44%, which is higher than the gross debt service ratio. So the total debt service ratio factors in everything that's in this section and then adds all your other debt. So at this point, we're saying 44% of your income cannot go to all the items in this section and whatever's in here. So in this case, this family is making $150,000 a year. At 44%, you're looking at $66,000. And we are at 43 and looking at another 72, so that's 50. So this deal would pass. All right. So if you walk into a mortgage broker's office or a bank, these are the ratios that they're going to be using to determine whether or not you have the ability to service your debts. So if those check boxes are ticked, then over here where it says capacity, you've met that requirement. The other requirements that they're going to look at is your credit worthiness. So what is your credit score? And they're usually looking for a minimum score of 640. And you can quickly determine that. Yeah, go ahead.
Yeah, just a couple questions. So Lee's asking, does rental income count dollar for dollar from the same person?
Does what, sorry?
Can you explain that, Lee? Does rental income count dollar for dollar from the same person? So Lee, are you saying gross income from rental property? Is that what you mean as income? Is that what you mean, Lee? Yes, if I had a rental income. So if we have rental income, Tarek, are they counting the whole amount, or are they counting the net amount that you get to keep? How is that?
So
How is
okay.
that added to income?
So under the mortgage underwriting, they're going to look at the income verification, right? So one of the big caveats here is, okay, so your total debt service ratios are in line. That's great, and your income is $150,000. That's your gross income. Okay, now prove your income. Okay, so let's say you've got $100,000 from your employer, and then you've got another $50,000 in different rental properties that you collect. So over here in the income verification rules, they're going to be looking for, prove to us that you make this $150,000. So show us a lease. And once you've shown them the lease, they're going to want to see that the rent goes into your bank account, and they're going to want to see that you pay taxes on it. So they're going to look at your notice of assessment, and they want to see that under that line, whatever that line indicates, that you are collecting rent and that you are declaring that as income. Now, the income itself, if you're depending on the lender that you go to, the gross income that you collect will be considered as income. So if you're charging somebody $1,000 a month rent, they're going to factor in that $1,000 a month into the calculation in your income. Now, some lenders will only write down half of it, so they'll give you 50% credit for it. So if you're charging $1,000, if you're collecting $1,000 a month in rent, they're going to count $500 for you as income. Some lenders what they'll do is they'll give you a maximum amount up to the amount of the mortgage. So, for example, let's say the mortgage on the properties, I don't know, let's say it's a $100,000 mortgage. Let's say your minimum payments annually are $12,000. So you're collecting $1,000, but you're paying out $12,000 to the mortgage. It's a wash. If you're collecting $18,000, but you're only paying $12,000 in a mortgage, they'll still wash it. Meaning they're not gonna give you more income than what you pay in the mortgage. Do you follow what I'm saying there, guys? Sam, is that clear?
It won't be counted. So in that scenario, they don't count the income at all.
They count the income, but they will not go past what the mortgage amount is. So if you're collecting $30,000 a year in rents, but your mortgage on those properties are only $20,000, then they're gonna count the income up to $20,000. They will not count it after that, right? So if you're thinking because you're collecting more than you're paying out, that's going to benefit you. It's not. It'll be considered a wash.
I see. Okay. So if I had a mortgage of $10,000 and I was bringing in $15,000, they would count $5,000. If I'm bringing in a mortgage income of $15,000, yeah, but they count 10,000 as income or cost? That's my mortgage.
Sorry, say the scenario again.
So I'm bringing in 15,000. My mortgage is 10,000. That leaves 5,000 excess. Is that what's counted? The 5,000, right?
No, the 10,000 is counted. The 5,000 extra that you make is a wash. They don't count it.
So they're gonna count $10,000 as income?
If you're collecting 15,000, but you're only paying 10, they're only going to count 10.
They're counting the mortgage amount, not the
No,
income, the extra
no,
money.
they're counting the income. Yeah, they're counting the income.
Okay. So what about and if it exceeds it, they just wash it. They don't count
That's
it
right.
at all. So
That's
if
right.
it's
So
15 in mortgage, 10 in income, there's a $5,000 loss. They don't count it at all.
they're counting $10,000.
Well, if I'm losing $5,000 a year.
Yeah. So the maximum they're going to go is to your mortgage amount. So if you're charging rents of $10,000, if you're collecting rent of $10,000, they'll count $10,000 of income. They'll count up to $15,000 of income because your mortgage is $15,000, but they will not count anything over and above that. So if you collected $30,000 on this property, but you only paid out $15,000, they're only going to put on their books $15,000
as income. So
as
they're
income.
counting. Oh, okay. So they're counting the money that I'm using to pay off my mortgage as income because it's being allocated.
That's right.
Oh, okay.
You're collecting rent. Let's just call it rent. Okay, you collect $15,000 of rent. They're going to put $15,000 as income. If you collect $15,000 of rent, but your mortgage amount is only $10,000, they're only going to count $10,000 of income.
So why? Just the part I'm confused about. My apologies. Is why are they counting the mortgage amount, not the surplus?
They'll never count the surplus.
They'll never count the surplus, the actual net income.
That's right.
They'll only count. So because I'm using. So let me ask you this:
this is most lenders. This isn't every lender, but most lenders will count just usually up to a maximum of whatever debt you're servicing, whatever the mortgage amount is.
So what if I'm 15,000 in income and 15,000 in mortgage? They're going to count 15,000.
They're going to count 15,000.
Wonderful. Okay, that's great. And the other question was, can you factor in an existing mortgage? Example, if you were getting a loan on a second house. What do you mean by that, Lee? Can you factor in an existing mortgage if you're getting a loan on a second house? Do you mean, Lee, you mean net worth, the equity you have in the house? Is that what you mean? And use that to leverage into another property? Is that what you mean? A security? You see that, Tarek?
No, I don't see the. Let me see it.
TDSR. To the TDSR. Is that added to the TDSR? So if I have a house, Lee, if I understand you correct, if I have a house and it's got a mortgage of $50,000, it's worth $100,000. The extra $50,000 and the equity, that's what we're talking about. Is that correct, Lee? We're talking about equity, right? No, you're not talking about equity. Are you talking about the cost? If I need a loan, okay. On a second house that you haven't bought, Lee, or you bought, do you own this second house? You're looking to buy a second house, is that correct? To buy a second house. Okay, look to buy a second house. I have an existing house. You're asking, how is the mortgage on the first property used in the calculation? Is that correct? Okay, so the cost of me servicing, that would be included in my mortgage payments, right? Correct?
Correct.
So, right, that would be an expense I'd have to recognize, right?
So what would happen here is, he would have two mortgage payments, two sets of property tax bills, and two sets of heating bills. All the other stuff here would probably be the same. So now the GDSR is what they're looking at, right? So as long as your income can support it, there's no issues there. Now, what they will take into consideration is if there's equity in that first house, that helps you with the collateral and it helps you with the capital. It does not change the capacity. So your ability to service that debt isn't greater or reduced because you have an existing home. Well, I mean, it's reduced. It
Because
can't.
it's accounted for.
That's right. It's counted for, right?
Yeah, yeah. Okay. Does that answer your question, Lee?
But what you can do, some lenders will do a blanket mortgage, and they'll say, okay, rather than getting a second mortgage on this other property, we'll do one mortgage for this entire amount, and they may put it all on one house. It depends on how much equity you're talking about.
Okay, so if I have I'm going after a second property.
Mm-hmm.
I have $100,000 house. I have $50,000 equity. I'm getting a second house that's costing $100,000. Instead of me getting a separate mortgage for the second property, you're saying they'll do one mortgage for both properties. Is that correct?
Yeah, you can do. They can go and just give you one giant line of credit on the first house, and then you can take the money out of that and buy your other property with it.
Yeah, sure, sure. That makes sense. That makes sense. Lee, does that answer your question? Okay, cool. Excellent. Excellent stuff, Tark. Really appreciate this. This is great.
You're very welcome, Sam. Okay, so I think we tackled most of the areas that I wanted to talk about tonight. We talked about the five C's of lending. Um, Sam, if you can, if you want to, I can save this, send it back to you, and then you can email it back out to everybody. And then you can have click
Yeah,
the
what
links
I'm
there.
gonna
These
do.
links are interactive.
Yeah. Okay. So what I'm gonna do, folks, is I'm gonna save it's I already saved it. What I'm gonna do is I'm gonna add it right now, so you can take this document. Give me 1 second. So add files here. Give me 1 second. Okay, give me 1 second. So it's called mortgage financing, correct?
I'm going to do it
There
for
we
you right
go.
now, Sam, because I have to save it for my end
Okay. No, no, no. I already got it. I already got it.
with the numbers in it.
Yeah. Well, not the additional numbers,
Okay,
but
let
you
me
got.
throw those your way.
Okay, so folks, I've put it up there. You can see a mortgage financing. That's the document without the additional notes from TARC. You're more than welcome to download that. What I will do is I will save the new document that TARC has worked on. I'll save it in the Dropbox and you can access it there, okay?
Okay, Sam, I just sent it to you.
Excellent. So I'll load that into the Dropbox tonight. Any questions for TARC before we wrap up? Any additional questions? This stuff's pretty deep. I mean, Tark. I mean, he could go for hours. What we can do is Tark will invite you back as soon as you can get back with us and maybe continue on that conversation. Just because, really, um, you know better than us. That's scratching the surface. That's just the identification of how to look at a lender. A lender looks at someone who's a borrower, but obviously the creativity um, that we can add to that, which I love you for. Would love to share some of that creativity and maybe have you folks come to the next session with some questions or situations and watch Tark use his magic, which I've seen several times, to find a solution for a situation. And I would really consider, if you have questions about your RSPs and things you can do with them. Tarek really believes in a balanced portfolio. You all know that I trade. Tarek trades too. He's a licensed trader. He believes in balancing out your portfolio in the market and in real estate. So if there's some of you that are looking to do something more with even your stock positions or at least your mutual funds, he'd be a great resource to talk and ask those questions. So if you're interested in doing that, Tarek, is it possible? You have to check your schedule. I know. Is it possible maybe to get you back next week or the following week?
Yeah, I can commit to another session. I'm not sure if it'll be next week or the following week, but I'll get back to you on that.
Yeah, okay. So we'll confirm a time with Tark, and I'll just be ready to bring them for next week. If he's not with us next week, do it the following week. But take advantage of this resource for sure. We definitely want to be able to to maximize our power team members, and Tark's one of mine, obviously, and
Sam,
what he's done.
I'll share a quick story with you before I head out.
Sure, sure,
I
sure.
had a client in the office a few weeks ago, and
Okay.
the lender, they had a maximum 34% GDSR that they wouldn't go over. CMHC does offer their insurance up to 39% GDSR. So in this case,
Okay.
the client was putting down 25% down payment on the home. So he didn't necessarily require the CMHC insurance, but we gave him the option to pay for some CMHC insurance so that we could bump up his GDSR from 34 to 39. So here's a situation where somebody paid more than 20% down payment, still paid some CMHC just to get the deal approved, right?
Oh,
Yeah.
that's interesting.
So you have to remember the ratios that the banks use and the ratios that the insurers use can vary. Most lenders are maximum 34% GDSR. If you're going past that, you'll usually get a quick decline. If you offer to pay for CMHC out of pocket, that gives them
Hmm.
the ability to bump your GDSR up to 39%. And then, if you need to get the deal approved and your income doesn't support it, but it's under the 39% threshold, pay the CMHC and get the deal done.
That's awesome.
Yeah,
That's creative. Yeah, that's creative. I mean, it's really about getting the deal done. Once the deal's done and you own possession of the property, you have a lot more available to you, right? With refinancing and lines of credits, accessing that capital. Obviously, when we're trying to get a loan, it's a lot tougher with property. There's a lot more rules and regulations. But once you own possession of the property, then we can talk about reevaluating or reassessing the value of that property and getting a loan accordingly for that. So that's the kind of stuff I'm talking about, Tarek. That's awesome. That's very, very cool. Lee's got
okay,
one more
Sam.
question. How does
Yeah.
how does the future income of the property factor in to the loan qualification? So what Lee's asking, if I understand you correctly, is I'm buying a second property. It's got income. Obviously, that's going to help me with that's going to be part of the income that's
They've
going to
got to
support.
produce a lease. As long as they can produce a lease or a rental agreement, they'll factor in half of that. Most lenders will factor in half of your rent. Some will factor
Yeah.
in all, up to a maximum of what the mortgage is.
Okay, so you got
Okay.
that, Lee. That the income does get counted. Yeah, the
Yeah.
income obviously because it is income. It's an income property. So the banks will many of the institutions will do the 50% rule. Some will be more creative or more resilient on how much they can qualify you for. But I was as a rule, and Tarek, you can echo this, and 50% is a good way to look at it generally. Of that income coming in once you've displayed or shown proof that that income is coming.
That's correct.
Okay, great. Any other
Okay, Sam.
questions before we? Sorry, go ahead.
No, that's it. Go ahead.
Okay. Any other questions before we wrap up the session, folks? Any other questions? Okay, if you're good, type in yes or Y. All good, all good, 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 good. All right.
Okay, Sam. Thanks a lot. I have to jet. Thanks for having me tonight, and thanks everybody for listening to me. And we'll talk to you guys soon.
Thanks, Tark. We really appreciate you spending the time with us, folks. We're going to wrap up for the night. We're going to see if we can coax Tark to come back for another weekend. Another week, and continue this conversation to the area of creativity. Thanks again, Tark.
Yeah, you're welcome. Have a good night, guys.
All right, folks, we're going to wrap up for tonight. Like I said, appreciate you coming out. Make sure you're here next Tuesday, and we will continue to develop a better understanding of creative financing. And if any of you have a power team member that you want to have on our look, I'm calling it a show now, on our show to share, somebody that that could benefit the group of us, the rest of your students, your classmates. I'm very open to that. They can come on and answer questions, and you can promote their business while they possibly could help our students out to develop their business. So if anybody's interested in that, has a power team member that they really like, they feel would be a good fit, email me and we can see if we can set up a time. Otherwise, I want everyone to continue working away. If you have any questions, you know how to reach me. Have a great week, and I will see you all next Tuesday.